Welcome to Allgen's Money Minute. Today we want to address the issue of active money management versus index investing. Which one makes more sense for you? So let's start with the definition of the two and what the differences are. Okay, index investing is where you try to replicate an index. For example, the S&P 500 of the largest companies in America. An investor will actually look, or a fund or a portfolio manager, to replicate that and just let it ride.
Yep.
Okay. So the good news is it's very simple. You pick the 500 and you roll with it.
Right.
Okay. The difference between that and active money management is that you're not actually trying to replicate an index, but you're trying to beat an index.
Right.
Okay. So they won't necessarily hold the same stocks. They may hold a lot less or very different stocks, but they're trying to take advantage of the nuances economically, the changes in the climate, to try to outpace any respective index.
That's right.
That's the difference between the two in definition and approach.
Mm-hmm.
Now, what are some of the pros and cons of each?
Yeah, so the pros and cons of the index investing, because it doesn't take that much work, it's a lot cheaper. So the fees are a lot less expensive, okay? And it's pretty simple. You know, you just pick a couple index funds and you go with it. So that's an advantage. Now the con is you take on the same level of risk as the market.
Right.
And so if you go through a rough time and the market takes a big hit, you're
2008.
going, yeah, like 2008, you're going down with the market, and a lot of people can't stomach that, and they
Right.
sell out at the low and they miss out at that big rise.
Right.
The other thing is you never beat the market. 100% of the time you underperform the market. You get just about what the market gets minus a small fee.
Right.
Okay. So the active money management, the pros with the active money management is you have the potential to beat the market. And there's a study out there that says 15% of professional money managers are able to beat the market over time, over a long period of time. So there are a small percentage of professional money managers that are able to actually beat the market.
Right.
And what we like is, alongside of that, is you're able to take less risk in the market.
Mm-hmm.
So you can go through 2008 and it's not as difficult to stomach that big drop because you don't drop potentially as much as what the market does.
Right.
But it's complex, so that's a disadvantage. If you're an average money manager, good luck trying to pick the right funds and stocks. It's very difficult to do that. So
Right.
that's why a lot of average investors go with the index investing.
right.
But we believe with the professional money management, if you're on top of it, you can potentially beat the market over time and keep your risk lower.
And what costs?
It is the disadvantage, though. It is more expensive
Right.
to do the active money management because it takes a lot more work.
Right.
You know, you're trying to find the right stocks, the right bonds, the right funds to beat the market.
Right. Obviously, we're biased. We believe you get what you pay for, so pay less, you might get less. But the call is up to you to make. Whatever you feel more comfortable with, please call us with any other questions. We hope to see you soon.